Hello viewers, welcome to my channel. I'm Hasham Ali Khan. So far we have discussed about working capital management. We have done so many problems on working capital management, cash management. Now in this video I'm going to explain you about the receivables management. Receivables means investment in credit sales. So when the business invests in credit sales, there are some benefits as well as some costs. The benefits are when the goods are sold on credit, the sales will increase because customers requires credit period. Very few customers will pay cash. Remaining customers will purchase the goods and they will pay it later. So this is called receivables. The benefit is that our profit will go up because sales goes up. The costs are regarding the bad debts, irrecoverable debts. Higher the credit sale, more is the possibility of bad debts. That is first thing. Second one is interest charges on money invested in receivables. The business has to make the investment in production of goods, and after producing the goods are sold, but money will not be received immediately. The cash will be received after a period of time. So till that time, the interest charges has to be paid. That is a cost. Apart from that, some collection charges are there. Sometimes collection charges are spent by the business. So higher the credit sale, more collection charges. These are the cost on maintaining the receivables management. Now, before starting the 21st problem, I expect my viewers to have a printout of the problems which are given in the link under my description. Always keep the problems ready. Take the screenshot of the solutions of 21, 22, 23rd. These three problems, then I'll explain all the points. Now, see the 21st problem. Problem number 21. The existing sales of SS company are rupees 50 lakh with partially liberalized credit standards, and company sales are likely to go up by 6 lakh rupees. So presently the total sales of the company are 50 lakh. Now the company wants to make some experiment on credit policy. Now, if the new credit policy is implemented, the company expects the sales will increase by 6 lakh. The average collection period is likely to be 45 days and the incidence of bad debt losses are 10% of the new customers. That means when the new policy is implemented, the period of the policy is 45 days and 10% will be the bad debt losses from these new customers. The contribution to sales ratio of SS company is 25% and the cost of funds is 20%. Contribution to sales, this is also known as PV ratio, profit volume ratio. So the contribution to sales ratio is 25%, means the contribution is 25% of sales. If sales are 100 rupees, 25 rupees will be the contribution, and contribution is the difference between sales and variable cost. Sales minus variable cost is equal to contribution. Always my suggestion to my viewers, always keep a notebook, pen, calculator beside you. While watching the video, a number of points I will explain. So take a note of those points so that you can be able to remember. Till examination, you can confidently face the problems. Then 25% is the contribution to sales ratio and 20% is the cost of funds. Interest charges are 20%. Calculate the additional benefit from the above data. That means what is the additional benefit the business will get if they implement the new policy. If the new policy is implemented, 6 lakh rupees are the additional sales. So here additional sales are 6 lakh. And the contribution to sales ratio is 25%, means 0.25. The formula for contribution to sales ratio is contribution by sales. This is the formula for contribution sales ratio. In this formula, contribution we don't have, But sales are given. Now how much are the additional sales we are getting? 6 lakh. So in place of 6 lakh sales, I am writing 6 lakh. So contribution by 6 lakh is equal to 0.25. Now if I make a cross multiplication, then additional contribution is equal to 6 lakh into 0.25. So 6 lakh into 0.25, 1,50,000 is the additional contribution the company is going to get from this new policy. From this additional contribution, we subtract the costs on this new policy. What is the first cost? Additional costs are bad debts. It is given in the problem. 10% is the loss of bad debts on this new policy. 10% of what? 10% of sales. How much are the additional sales? 6 lakh. So 6 lakh into 10%, you will get 60,000. These are the expected bad debts we are going to incur on this new policy. Then return on additional investment in receivables. How much is the additional investment in receivables? Now see here. Contribution sales ratio is 25%. That means contribution is 25% of sales. That means the variable cost is 75% of sales. When contribution is 25%, the variable cost are 75%. So for this 6 lakh rupees, 6 lakh rupees is the sale value. What is the cost of this 6 lakh? 75% of 6 lakh, because 25% is contribution. So in 100 rupees of sales, 25 rupees are contribution, 75 rupees is the cost. So here, the PV ratio is 25%, therefore the variable cost is 75% of sales. So investment in receivables are 75% of 6 lakh. It comes to 4,50,000. So 4,50,000 is the investment made. So 4,50,000 into how much is the credit period allowed for the new customers? 45 days. So we assume a year to consist of 360 days. Actually, year consists of 365 days. But for our calculations purpose, for easy calculations, we make an assumption that year consists of 360 days. So 45 by 360. So 4,50,000 into 45 by 360. This is the additional investment in receivables. On this additional investment in receivables, how much is the return we require? 20%. That is given in the problem. Cost of funds, interest charges are 20%. So 20% of this amount you will get 11,250. So 4,50,000 into 45 by 360 into 20%, 11,250 are the interest charges on money invested in receivables. Now take the total. 60 plus 11,250, 71,250. Now 1,50,000 is the additional contribution we are getting. And additional cost we are incurring 71,250. Subtract. So 1,50,000 minus 71,250, 78,750 is the net additional gain from the new credit policy. So if the company implements the new policy, the sales will increase by 6 lakh, the contribution will increase by 1,50,000, and the cost of these receivables are 71,250. So there is a net gain of 78,750. So ultimately we suggest the company to go ahead with this new credit policy, because there is a net gain of 78,750. That's it. This is the problem 21. Now 22nd. Calculate additional investment and additional benefit from the following information, just like the previous problem. A company's existing sales are 180 lakhs. It is currently extending a credit period of net 40 days to its customers. The company's contribution sales ratio is 20% and the cost of funds is 15%. The company is expecting to increase its sales by 24 lakh to be achieved by the means of expansion the existing period to net 60 days. Presently the company is allowing 40 days. Now there is a proposal to increase the credit period to 60 days. Now, if the company implements to 60 days, then what will happen? The net sales will increase by 24 lakh. The new additional sales will be 24 lakhs. And the bad debt losses on additional sale is expected to be 10%. 10% are the bad debt losses. Assume 360 days per annum. Previous problem, this assumption was not given, but we have assumed 360 days. In examination, you should write a note that it is assumed the year to consist of 360 days. Now, 23rd problem. How much is the additional sales? 24 lakh. And contribution to sales ratio 20%, 0.20. What is the formula for contribution to sales? Contribution by sales is equal to 0.20. Contribution we don't have, but sales we have. How much are the additional sales? 24 lakh. So in place of sales, I am writing 24 lakh. Now cross multiplication. So contribution is equal to 24 lakh into 0.20, 4,80,000. From the new credit policy, the company is going to get additional contribution of 4,80,000. This is the additional benefit, gross benefit. From this gross benefit, we deduct the additional cost. What are the additional cost? Bad debts. It is given in the problem, if new policy is implemented, 10% are the bad debt losses, 10% of sales. How much are the sales? 24 lakh. So 24 lakh, 10%, 2,40,000 are the bad debt losses, expected bad debt losses. Now return on additional funds invested in receivables. PV ratio is 20%. Contribution sales ratio is 20%. So if 100 rupees are the sales, 20 rupees are the contribution. 80 rupees is the variable cost. Variable cost. So we are investing how much? 24 lakh. 80% of 24 lakh is the variable cost. Here, the PV ratio is 20%, so variable cost is 80% of sales. So additional investment, 80% of 24 lakh, it comes to 19 lakh 20,000. These are the additional benefit, additional investment. It is not additional benefit, it is the additional investment. Additional investment is 1,92,000. No, additional benefit, this one, correct. So ultimately, finally 1,92,000. So 19,20,000. What is this 19,20,000? Is the additional funds invested in receivables. Now, return on additional funds invested. Additional funds invested 19,20,000 into 60 by 360. Because it is given in the problem, when the new policy is implemented, the credit period is 60 days and the year is assumed 360 days. So 60 by 360 into 15% is the cost of funds. The interest charges, cost of funds, 15%. 48,000 are the return on additional funds invested. So 2,40,000 plus 48,000, 2,88,000 is the additional cost. How much is the additional contribution? 4,80,000. Additional cost, 2,88,000. So 480 minus 288, 1,92,000 is the net gain. It is the net additional gain. So additional benefit is 1,92,000. So we suggest the company to go ahead with the new credit policy. Because when the new credit policy is implemented, the company is going to get additional benefit of rupees 1,92,000. That's it. 22nd problem I have completed. Now see the 23rd problem. XYZ Limited is examining the question of relaxing its credit period policy. Relaxing means extending. Presently a lower credit period is given. Now the company wants to give higher credit period. For example, we are allowing the credit period of 1 month. Now there is a proposal to lengthen the credit period, increase the credit period. Instead of giving 1 month time period, we will allow 2 months time period. It is called lengthening the credit period. Why we lengthen the credit period? To have additional sales. The sales will increase. Higher the credit period, more will be the credit sales. When more sales are there, more profit will be there. That is the benefit. Now XYZ Limited is examining the question of relaxing, increasing the credit period policy. It sells at present 10,000 units at a unit price of rupees 100 per unit. and the variable cost per unit is 75 rupees, and the average cost per unit at the current sales volume is 80 rupees. Now listen carefully. Presently the company sells 10,000 units, and the 10,000 units are sold at a selling price of 100 rupees. Now variable cost is 75 rupees, average cost is 80 rupees. Actually average cost includes both variable cost and fixed cost. So from average cost, if you deduct the variable cost, the remaining is the fixed cost. Fixed cost is not given in the problem. By using average cost and variable cost, we can calculate fixed cost. Like this you can see here. Average cost per unit is 80 rupees given here. From average cost, deduct the variable cost per unit 75 rupees. So 80 rupees average cost, 75 rupees variable cost. So 5 rupees is the fixed cost per unit. But we need the fixed cost in total. So presently how many units are being produced? 10,000. So present number of units are 10,000. So presently total fixed cost is 10,000 units into 5 rupees, 50,000. The total cost, fixed cost is 50,000. And remember one point, the fixed cost is a cost that will remain same whether we make 10,000 units or 15,000 units or 20,000, any number of units. The fixed cost is a cost that will remain same. So this fixed cost is going to remain same. All the sales are on credit. The average collection period 45 days. A relaxed credit policy is expected to increase the sales by 20% and the average age of receivable to 60 days. Now remember, see, presently the credit policy given is 45 days. Now, if the company wants to relax the credit period is going to be increased to 60 days. The present policy we are allowing 45 days credit period. New policy, proposed policy, the company wants to extend it to 60 days, right? And the sales will increase by 20%. Presently, the sales are 10,000 units. It is given here. Present sales are 10,000 units. If we implement the new policy, the sales will increase by 20%. So 10,000 into 20%, 2,000 units will increase. Presently, we are selling 10,000 units. In the proposed policy, the sales will become 12,000 units. 20% increased. Assuming 15% return, that means the cost of funds invested, return on additional funds invested is 15%. Should the firm relax its credit policy? Now we have to evaluate and tell the company whether this relaxed period is beneficial or not. When it is beneficial, when we get net gain. If there is a net loss, there is no benefit. How to calculate net gain? Take the additional contribution, additional benefit. From additional benefit, deduct the additional cost. And one thing is there, it is not mentioned regarding bad debts. Last two problems we were having bad debts, but in this problem, no bad debts are there. Now see here, evaluation of proposed credit policy. So two columns at the extreme right hand side. The first column present policy, second column proposed policy, particulars. First of all, number of units. Presently, number of units are given in the problem 10,000. Same thing I have taken. Proposed policy, the number of units are going to be increased by 20%. So 20% it is increased. So 10,000 into 20% is 2,000. So 10,000 plus 2,000 is 12,000 units. Present credit period is 45 days. And the proposed policy 60 days. Next. Sales. The selling price per unit is 100 rupees per unit. So multiply selling price with number of units. So 100 into 10,000, 10 lakh. 100 into 12,000, 12 lakh. That we denote it as A. A is the sales. Now variable cost. Variable cost per unit is 75 rupees given here. 75 rupees is the variable cost per unit. Multiply 75 into number of units. So 75 into 10,000, you will get 7,50,000. 75,000 into 12,000, 9 lakh. So variable cost we got. fixed cost. In working notes just now we have calculated fixed cost 50,000. This fixed cost will remain same whether we make 10,000 units or we make 12,000 units. The fixed cost will remain constant. So 50,000, 50,000. Take the total 7 lakh 50 plus 50, 8 lakh rupees, 9 lakh plus 50,000, 9 lakh 50. This is the total cost B. Total cost consists of variable cost plus fixed cost. So variable cost plus fixed cost, total cost. We already know the formula for profit. Profit is equal to sales minus total cost. So sales are 10 lakh, total cost is 8 lakh. So 10 lakh minus 8 lakh, 2 lakh rupees is the profit at present. In the proposed policy, relaxed policy, the profit will be 12 lakh minus 9 lakh 50,000, 2 lakh 50,000. So you can compare the profit. Presently we are getting a profit of 2 lakh rupees. And the proposed policy, new policy, our profit is going to become 2 lakh 50,000. How much is the increase in profit? From 2 lakh to 2 lakh 50,000. 50,000 rupees is the increment in profit. So increase in profit is 50,000. That is the benefit we are going to get from the new policy. Now, investment in receivables. What is the total cost at present? 8 lakh. And how much is the credit period given at present? 45 days. Presently period is 45 days. So in 1 year, the total cost is 8 lakh. For 1 year, but we need for 45 days. So 45 by 360. So 8 lakh into 45 by 360. It is assumed the year to consist of 360 days for our easy calculations. Otherwise, you may take 365 also. So if you take 360, write a note after the problem that it is assumed the year to consist of 360 days. So 8 lakh into 45 by 360, 1 lakh rupees is the investment in receivables in the present policy. In the proposed policy, 9 lakh 50,000 is the total cost. So 9 lakh 50,000 into 60 by 360. Because in the new policy, the credit period is extended to 60 days. So 60 by 360, it comes to 1 lakh 58,333. This 1 lakh rupees is the investment in receivable at present. And in the future policy, the investment in receivables is coming to 1 lakh 58,333. So how much is the additional funds invested in receivables? So 158,333 minus 1 lakh, it is 58,333. This is the additional funds invested in receivables. Right? Additional funds invested in receivables, 58,333. And the return required on additional funds invested in receivable is 15%. This is the cost of capital. So company needs 15% on additional funds. So return on additional funds invested at 15%. 15% of 58,333, it comes to 8,750. This is the return on additional funds invested. That's it. So by evaluating this information, two things we come across. One is the benefit, the other is the cost. Benefit is the profit. The cost is the return required on additional funds invested. Now we make a trade-off between benefit and cost. Trade-off between benefit and cost. The benefit, increase in profit. How much is the increase in profit? 50,000. And the cost are return on additional funds in receivables, 8,750. So business will incur a cost of 8,750. The business will get a benefit of 50,000. So 50,000 minus 8,750, 41,250 is the net gain from the new relaxed policy. So ultimately, after completing the solution, you should write the conclusion. It is suggested to the company to implement the new policy of 60 days. New credit policy of 60 days because the company is going to get a net gain of 41,250. That's all. So in this video, 3 problems I have explained in detail, 21, 22, 23. If you want the complete command, watch the video till the end, don't skip in between. If you are unable to understand in the first attempt, watch the same video second, third time, definitely you will get a good command on these problems. And these problems are very important not only from the point of view of graduation level, but even for post-graduation level, for professional exams. These problems are very, very important. So I wish you all the best for your preparations, for your exams. Inshallah, we'll continue the next problem in the next video.